Tilray Brands, ticker TLRY, is currently trading live on the Nasdaq at $150 per share, up about 1.35% in this morning's session on October 24, 2025. The stock has seen some modest green after opening near 148 and has touched a high of 153, all on fairly significant volume that's already approaching 10 million shares. The expectation for months has been that this stock is just a coiled spring, a simple binary bed, waiting for the U.S. government to finally act on cannabis rescheduling. But the reality of today's price action, and frankly the price action of the entire last year, is far more complicated. The stock isn't just a political proxy, it's a company in the middle of a painful and forced transformation, and it's also a battleground stock for one of the largest short positions in the entire consumer sector. Let's establish the common ground, because this is what unites almost every long-term holder of the stock. The primary narrative, the one discussed endlessly on X and Reddit, is U.S. reform. The hope is that the DEA will finalize its move to reschedule cannabis from Schedule 1 to Schedule 3. This, in theory, would be the first domino. It would be followed, investors hope, by the Safer Banking Act, which would allow U.S. cannabis operators to access normal banking services, and critically, allow Canadian companies like Tilray to enter the U.S. market without being delisted from the Nasdaq. The expectation is that when this happens, Tilray, with its established global infrastructure and aggressive acquisition strategy, will be one of the few giants left standing, ready to pounce on the largest cannabis market in the world. This belief has kept millions of retail investors holding on, watching their positions swing wildly on every vague headline out of Washington, D.C. Now, let's challenge that. The reality is that this singular focus on a political event that has been just around the corner for 3 years is a massive vulnerability. While everyone has been watching Washington, the actual business of Tilray has been changing under their feet. The company's most recent earnings report earlier this month was a perfect example of this disconnect. The core Canadian cannabis market, which is still its primary operation, remains brutal. Revenue in that segment was down 9% year-over-year in the last fiscal year. It's a low-margin, hyper-competitive, and overtaxed environment. Tilray is the market leader in Canada, celebrating 7 years of legalization there, but it's like being the captain of a very small, leaky boat. The real story, the one that the market is struggling to price, is the beverage alcohol segment. Thanks to acquisitions like Sweetwater Brewing, Montauk Brewing, and others, this part of the business is growing. It's providing stable, predictable revenue. The expectation is pot stock. The reality is that Tilray is aggressively morphing into a diversified consumer packaged goods company that just happens to have a massive speculative cannabis division attached. This is why the stock is so difficult to value and why it chops around $1.50. The market can't decide if it should trade at a boring beverage multiple or a high-growth or high-bust cannabis multiple. Today's 1.3% move is just noise within a much larger, violent downtrend. The stock is still down significantly from its 52-week high of $2.32 and is a painful 99% below its all-time highs from 2018. The current macroeconomic climate is a massive headwind. Higher-for-longer interest rates are poison for companies like Tilray that are not consistently profitable and rely on capital markets to fund operations and acquisitions. Every basis point the Fed holds rates up means Tilray's debt is more expensive and its path to positive free cash flow is harder. This macro pressure is what gives ammunition to the other major player in this story, the short sellers. We have to talk about the short interest because it is a dominant factor in the daily price. This isn't a theory, it's a fact. As of the most recent data, the short interest in Tilray is exceptionally high, often fluctuating between 15 and 25% of the entire public float. This is not a small, quiet bet. This is a massive, concentrated institutional position that the stock is fundamentally overvalued. The short thesis is not complicated. They are betting that U.S. reform will take too long or be ineffective. They are betting that the company's core Canadian business will continue to struggle, and they are betting that the acquisitions in the beverage space were too expensive and won't be enough to offset the cash burn from the cannabis side, leading to more dilution for shareholders. This intense short pressure is why you see the stock struggle to hold its gains. Any pop, like the one we saw earlier this month on earnings, is met with a wall of selling as shorts defend their positions. The borrow fee rate, the interest rate short sellers must pay to borrow the shares, has been consistently high. This tells you two things. The demand to short the stock is immense, and it's very expensive to maintain that short position. This creates the coiled spring tension. If the shorts are right, the stock will eventually break below its support levels, possibly even retesting its lows near 35 cents. But if they are wrong, and a genuine, unexpected catalyst like a finalized DEA announcement hits the wire, the rush to cover those short positions could be violent. This is what's known as a short squeeze. The days to cover ratio, which measures how many days it would take for all shorts to buy back their shares, is often elevated, meaning it would take them a long time to get out, potentially exacerbating any upward move. What's your opinion on this? Comment below. Do you think the high short interest in Tilray is a sign of smart institutional analysis, or is it a dangerously overcrowded trade setting up for a squeeze? For investors trying to navigate this, it's critical to know where to find this data. You can find the official, though delayed short interest data on the Nasdaq and FINRA websites. This data is published twice a month. For more real-time estimates of short interest and borrow fees, many traders use subscription services, but the official data is the benchmark. Recognizing a short attack versus a simple sell-off is about watching volume. If you see a sudden massive spike in selling volume on no news or on a flimsy negative report, that can be a sign of coordinated shorting. The responsible reaction is not to panic, but to reevaluate the short thesis. Do they have a point? Has something fundamentally changed? Chasing a squeeze is one of the highest risk activities in investing. A more durable strategy is to understand why the shorts are there and decide if you believe their thesis will fail over your time horizon. Looking closer at the business itself, Tilray is a global company. It was formed from the reverse merger of Tilray and Afria. Its operations are threefold. First, the Canadian cannabis market, where it holds the #1 market share with brands like Good Supply, Redican, and Broken Coast. Second, the international medical cannabis market, where it is a leader in Europe, particularly Germany. The slow rollout of legalization in Germany is a major and often overlooked potential catalyst for this segment. Third, the U.S. operations, which currently consist of the Sweetwater and Montauk beverage businesses and the Manitoba Hype Foods business. The U.S. cannabis strategy is all optionality. They own convertible notes in U.S. companies like MedMen, which they can convert to ownership only if federal law permits. This brings us to the future outlook. The path for Tilray is truly a fork in the road. Scenario A is the one the shorts are betting on: regulatory gridlock. If the U.S. election cycle pushes reform into 2026 or beyond, Tilray will be forced to trade purely on its fundamentals. In this world, the expectation of a quick win collapses. The reality becomes a long, slow grind. The company will have to prove it can achieve positive free cash flow from its Canadian and beverage segments alone. If it can, the stock may stabilize. If it can't, it will face more dilution and a falling share price. Scenario B is the one the retail longs are waiting for. The expectation is that rescheduling is announced. The reality of what happens next is what matters. An initial spike is almost certain, as shorts are forced to cover, but the lasting move will depend on the details. Does rescheduling to Schedule 3 actually open the door for Canadian companies, or does it just help U.S. MSOs on their taxes? The real catalyst is the Safer Banking Act. If that passes, it allows Tilray to consolidate its U.S. options and truly begin its U.S. invasion. That is the event that would force a permanent re-rating of the stock. The recent earnings, where they reported a surprise small profit, gave the bulls some hope. But digging in, that profit was largely due to non-operating factors. The core business is still fighting for every dollar. The stock remains pinned between the psychological support at $1.25 and resistance around $1.75. It will take a massive external catalyst to break this range for good. Let us know your position. Comment below how many shares of Tilray you currently hold, or if you're waiting on the sidelines for a clear signal. In the end, Tilray Brands is the poster child for market tension. The expectation is that it's a simple, high-leverage bet on U.S. politics. The reality is that it's in a massive battle between retail hope and institutional skepticism. The shorts are betting time is on their side. The longs are betting a single signature from Washington is all that matters. Understanding this fundamental conflict, the struggling reality of today versus the explosive potential of tomorrow, is the only way to truly understand this stock.